I just recorded one of my favorite episodes of housing news of all time. Today's guest was actually referred to me by two of my team members at HW Media, Jennifer Laws, who leads our sales organization, and Mike Simonson, the president and founder of Altos Research. They both suggested that I have to have Alex Villacorta on the Housing News podcast to learn more about his expertise in housing data and how he, as a co-founder and chief data officer at ResiShares, is applying housing data to make smarter investment decisions. ResiShares is specifically focused on the single-family rental asset class, and we go deep into his understanding and investment strategy of acquiring and operating and raising capital to own single-family rental assets and how they're applying data to educate a really smart and differentiated strategy. Alex has an incredibly impressive background in the housing industry with experience at some of the most innovative valuation and appraisal companies in the ecosystem. In his background with a PhD as a statistician, Alex approaches the housing ecosystem with a very different lens than many other guests that we have had on this show. In the second half of the episode, Alex goes out on a limb and makes some predictions for 2023 based off the data that he and his colleagues at ResiShares are analyzing and making bets on. I hope you enjoy this episode with Alex Villacorta, co-founder and chief data officer at ResiShares.
Hi, this is Sarah Wheeler, editor-in-chief of HW Media, and I'm talking to Ed Messman, CEO at Rook Capital, about their shared value investment program. Ed, what sort of investors are most interested and supportive?
Yeah, we're finding that there's three types of investors that are most interested. Those that care about housing affordability for this generation. Foundations, family offices are in that category. Secondly, those that care about their local communities, and those would be individuals, employers, that really are concerned about their local communities. And then lastly, just overall investors that are interested in the asset class of single-family, owner-occupied residential.
Thanks, Ed. And listeners, you can find out more at rook.capital.
So from a portfolio perspective, is there a future where you can give an investor concentrated exposure to Tampa? Or would a REIT structure bring more diversification, less focus on these future Denvers?
Yeah, I mean, that's the goal. I mean, each set of capital kind of has their own requirements on diversification, but really the idea is to do the former, is to have those geographic largely geographic concentration. But again, I also mentioned thematic. So you might say something like, I want to invest in, or what we're seeing because of the house. This is an example, because of the housing stock shortage. The new in vogue housing type are homes pre-1950 that are being completely renovated. So almost like in a construction in place, reconstruction, maybe we call it in place. And that type of asset is prevalent in the Midwest. So there's a theme that there's this pre-1950 reconstruction in place that is driving investment. So I give that as an example because it doesn't always have to be the Phoenix or the Tampa or an Atlanta or a very specific market. Although, real estate, the three tenets of real estate, right? Location, location, location. So obviously there is a strong geographic pull to all of this, and that naturally will manifest itself in these portfolios that are Florida-based, for example. Maybe you have like a Tampa, Orlando, Lakeland type, portfolio. Or you can have like the Mountain West where you have, the Denvers and, Albuquerque's, Colorado Springs, the different, metros along the Front Range. And then, obviously the Sun Belt has kind of been a theme that's been around for a few years. But, that's the goal. It's just to find, again, what the data informs is the most, optimal for real estate investing.
Man, I want to dig more into your Tampa work. I'm a native Floridian. My wife grew up in Sarasota area. I'm from Vero Beach. We live in Dallas now, which has been a hot market in itself. But it's wild when I look at real estate near our respective parents and just the price appreciation of the last few years. It almost feels like we've been priced out to an extent of the way we thought we could have lived 5 years ago in Florida. And I want exposure to Tampa just so I don't keep getting priced out of our future home in Florida one day.
What you just described is the whole impetus for ResiShares. is exactly that. Exactly as you said it. We would love to offer a product to you, Clayton, and say, we got you. You're not ready to go back to Tampa, but you can put maybe the equivalent of a down payment, or half or a third of that, let's say $20,000, $60,000, somewhere in there. And you say, that's going to go into my ResiShares Tampa fund, and we will track HPA for you in Tampa via the portfolio of SFRs that we're managing in Tampa. Obviously, that's baked into that is the home price appreciation, but also obviously the yielding. It captures the demand on the rental side, and it's a really attractive asset, in its own right for you. So thank you for that.
And that's a fascinating capability. I mean, like you think of like institutional real estate investing through such a institutional lens of like where like hedge funds and insurance companies and banks are allocating capital, but like if it's in my vision or anybody's vision that one day they're going to retire to Florida or Arizona or Hawaii, like why not get exposure earlier in your life? So like that decision, you're not priced out of at some point. These are like, these are nice problems to have, right? This isn't like this isn't the affordability issue that we're talking about in the broader housing market, but it is a extremely unique tool if that's accomplishable.
100%. I mean, and that exists in the equities market, right? You can, your 401k, you can slowly put away, portion of your paycheck every month into these funds for a vision for the future. So again, we're not trying to necessarily reinvent the wheel here. This isn't like the newest idea ever, but because of the way the housing market has always been structured, there's been so many barriers to crafting something like this. But the reason why we did this now, the reason why I believe we're finding success both now and in the future, is because all these different components to making this idea work are now here. Now they're now here at scale. There's now proof that SFR at scale is possible. There is now a vendor ecosystem. There is now even a shifting demographic appetite for renting versus buying. You talk about affordability issues. That's a major reason why the home ownership rate is decreasing. It's just, and we can get into that if you want. There's a whole host of reasons why that's happening. But
no, let's get into that. I'm thinking through like single family rentals as a source of like capital appreciation to one day afford what I want to afford, which is an ownership argument. But like at its core, we're talking about a rental product. So what were some of the like pre-ResiShares? Like what were some of the trends that you were seeing of like why the rental market, the SFR market, was a market worth betting on? And like what were like the demographic, cultural, economic considerations that enabled this asset class to kind of change from what I've categorized as like post GFC as like an asset class of necessity, where people came in and bought the bank owned assets and like turned them into rentals because that's where the market was, to what it is today, which from my point of view is entirely different.
You said it best. The GFC. That's where I would start. I mean,
okay.
If you go back like really 2002 and back, obviously, like all things, there were cycles to the housing market, but they were never this pronounced. Largely, I mean, Great Depression notwithstanding, but for the most part, their housing was boring. I'm sure you've heard that term before, the boring real estate.
I wish it was more boring. It's been too active recently.
Exactly. And that all plays into your question, which I'll answer here. So you had this boring market for years and years and years that roughly matched inflation plus, and you had this kind of role of first-time home buyer, your household formation. You had a certain percentage of that went to the housing stock. They bought out the last generation's first-time home buyer, and you had this cycle from first-time home buyer to move-up buyer to eventually downsizing, and that's really how the market churned. Then you get to GFC. That supercharged everything on the way up. You had massive home ownership, and then just as quickly, you had a massive drop. You had all this asset valuation drop, and amidst all of that, the population did not decrease. You still had the population of the United States non-decreasing. You still had household formation, even a slower household formation, which we're seeing more, as time goes on, is still a positive household formation. And all of that coupled with the pullback in the housing market. So you said, oh, I wish we'd go back to boring. I think a lot of people say that because the run-up was so severe and the downturn just as much that everybody, a lot of the industry entrenched themselves to say, hey, well, we almost had a full financial collapse in 2009. And there's been a ton written about it. I'm not going to go into it, but depending on where you sit, we were days, weeks, months away from like total economic collapse.
Hours. You remember those Sunday nights? Man, I was working in New York at a big depository. Sunday nights sucked for a long time.
Oh yeah, exactly. So after all that, you get fatigued, and you're like, you know what? I just need a break. We had the moratoriums. Everybody kind of took a breather. There was obviously major problems in the housing market. You were talking about foreclosures and the REOs. That was a major issue. But the net of all this is that home building slowed, if not stopped almost altogether. You had continued household formation, and you ultimately got to a point where people were disenfranchised with the American dream of being a homeowner. Like, why bother? I just saw my parents or my loved ones lose everything in the housing market. So I think that the psychological shift, the decrease in housing construction, along with the continued household formation, people got to live somewhere. And if people got to live somewhere, they're going to live in either apartments or houses. And the house product, the SFR product, is really catering to those people who, are kind of in between, that maybe could buy a house and are choosing not to, or are just outside of that range of affordability to have the down payments and increased home prices. And we're providing, or not just us, but the SFR industry is providing that product that fills that gap of home ownership, quote unquote home ownership, that home ownership experience, without all the overhead of the home maintenance, the large cash outlay, and that financial commitment. So I think that's why we took the bet on this space and are still very bullish despite the current economic environment, because it takes a long time to build houses. And at the rate we would need household construction to go, we're talking decades to get back to that boring old housing. So we think we're in early innings here.
Yeah, if you can underwrite deals at this cost of capital, I think you'll be fine for the next decade. So Alex, we've I've heard a lot about ResiShares and the approach. You mentioned valuation several times. I think that's a good prompt to bring us in to your background. Why are you so uniquely qualified to be part of the team and leadership team that executes on this strategy?
Well, I'm a statistician by trade. I got my PhD in stats back in 2006. And in statistics, and really when you dive into it at that graduate level, really what you're looking at is the science of uncertainty. And I love that phrase. It's from my advisor. He really advocated for us to understand that the world is uncertain, data is uncertain, but as a statistician, there are tools to measure, extract, clean, and understand the signal behind the noise. And when I really fell, backwards into real estate, and I never bought a house. I was just coming out of college. I had no idea what was going on, but I knew that with the data, I knew that there was tremendous opportunity to clean it up and to see those signals behind the data. And of course, that manifests itself most with valuations, particularly AVMs. And back when I started at Clear Capital in 2007, it really was all around understanding how do we understand the value of a house without seeing it and without having any intimate knowledge of it, just looking straight at data. And that's a classic statistical problem. So fast forward 16 years, that's what I've been doing, is looking at all kinds of real estate data and understanding both the pros and the cons, or the signal and the noise, within each of those data sets. And that's everything from, public records, which is, your county records and the transactions and the tax roll, to MLS, which is the active market. This is a lot what Mike and the Altos team look at on a regular basis, the new listings, the absorption rates, all of that stuff. To a large part of my career was spent with appraisal management firms. So that's another valuation class of, these trained experts, these appraisers out in the field that have a wealth of knowledge collectively in their minds about valuation and the nuance of like, well, house A looks different from house B because of reasons. Tell me these reasons. And the more those reasons get documented, are structured, you start to see innovations in valuations like you're seeing from the GSEs now. The GSEs have been tracking all this information and I know many of them quite well. And I've been employing these same type of statistical methodologies to do exactly what I'm saying, to identify true valuation with just data signals, which leads us to kind of where we are in this valuation world, which is valuations are kind of made up of three components. One is like the factual data. The other one is the inspection. And then the third one is this narrative that brings them all together. So the data one, I would say we're pretty much there. Everyone feels pretty good about that. The inspection one is really fascinating right now because there's a lot of innovation in that space. You look at, for example, like digital scans, 3D imagery of interior properties, outdoor properties. Obviously, you have drone image capture and video capture. You have a lot of digital observations or inspections that can be done now very cheaply. And then the narrative part, I won't get into ChatGPT and all the AIs and all that stuff, but I think even with a much simpler model, without even getting into what I think a lot of people think AI is, you can come up with these narratives that could rival, I think, kind of traditional approaches for a very simple use case right now. So I'm talking like your cookie cutter homes, track homes, properties with the lowest risk. Those are already ripe for this valuation innovation. And again, you look at some of the programs in the GSEs, they have their appraisal waiver programs, and a lot of those programs are based upon their own AVM technology. So the fact that they're putting their money where their mouth is and being how big they are in this industry, obviously signifies that I think we're there.
We're seeing that a lot of the more kind of innovative business models are leading the way forward on the future of valuation. And we're seeing like the forward mortgage industry and the GSEs watch the progress of what's happening on the investment side of the industry for learnings on like how the single family market, the single family ownership market can operate in the future. And we're seeing you and ResiShares team deploy capital and buy assets using data and your valuation models. We're seeing some incredible innovation come out of the AMCs and evaluation companies that you've mentioned. But then we've seen some of like the iBuyers kind of screw the pooch and like with the same data, with with similar models, just kind of develop business models that didn't work or didn't value assets properly or didn't take all the dirt into consideration. We're talking about real assets here. So how do you think like what happened in kind of the iBuyer space influences the way you think about valuation models and the way the GSEs will think about the future of valuation from a single family residential home ownership perspective?
Sure. I think it goes back to those three kind of components of the valuation. And obviously without knowing intimately how each of the iBuyers have particularly, kind of put their acquisition strategies together, I can only speculate. But again, if you go back to those three, we're all looking at the same data. Okay, so that we should be on par with. We see the public records, we see MLS. We should all at this point, again, you don't necessarily need PhDs, but they probably help to find the nuances there. But we all should pretty much see what we see in the market. We see the transactions, we see the listings. The next one is the inspection. The inspection one is significant because what you see on paper in the data, you see a 3-bedroom, 2-bath, 1,500 square foot selling for $300,000 in Dallas. You might think, great deal. I want that. But without that boots on the ground inspection, if you can't see what's in the house and what you're actually getting for that, then you're going to be, pretty much caught with some other issue down the road. And I think with the iBuyers, again, without knowing fully their acquisition strategy, that might be the area that was probably the most difficult for them to do at scale. Because we were talking about valuation companies like appraisal management companies. I know a lot of them. I've worked with them in the past. That is a hard problem to solve at scale. So if you're an iBuyer now, where your whole business model is based upon this acquisition from sellers, and you need to do it fast in a way that you're able to, convert these leads. I'm again speculating. I'm imagining there's some corners cut on doing the full due diligence on those acquisitions processes. And then the third one is the narrative. So there may be a a reason why you might want to buy a total gut rehab job. But you have to go in eyes wide open to that. And that's where I think the narrative comes in terms of, okay, you've got a great fixer-upper, but is that the right fixer-upper in the right neighborhood at the right time? That's the narrative. That's that last part that takes in more of a lot of what we're doing here at ResiShares in terms of understanding the market dynamics, the neighborhood dynamics, and how that all comes together with the asset opportunity. They're all three related, and where you are in the neighborhood matters where you are in the market, matters where you are relative to the nation. And so without having that full context, it's very difficult to just blindly buy assets and say, no, this is going to work out because my AVM tells me it's going to.
So at ResiShares, can you simultaneously execute a strategy that does like turnkey rental ready, lipstick deals, and gut reno deals? Like, can you look at all like three categories?
100%.
Okay.
Exactly. And that goes back, but it's, to get there was difficult. I say that quickly, like for sure we can do that, but that's only because of the investments we made in this business to get there. Like you can't, you can. It's very difficult to be able to service those types of investment strategies if your platform isn't set up to do that. And that's what we've been spending the last 3 years building, is a systematic way to analyze deals, to analyze opportunities in a way that's not requiring, a whole new human-based team in Dallas. And okay, that's our, gut reno job. We have another team out in Santa Ana, and that's going to be our turnkey lipstick jobs. That's just too much, and it doesn't scale. So again, yes, we can do it, but largely because of the platform we built. Otherwise, it's a tough task.
Okay, so as we think about like sourcing of real estate assets, like our audience here at HousingWire and for Housing News is made up of a lot of housing professionals across mortgage origination, servicing, real estate brokerage. Should like servicers be thinking of ResiShares as a buyer for disposition? Should brokers be thinking of ResiShares as a buyer for certain assets? Like how should the industry think of you?
Yeah, 100%. We are a buyer. Full stop. The types of buying that we do obviously depends on the capital we're buying on behalf of. But again, as a platform, and particularly as the chief data officer, I want all comers. Bring it all. I can't guarantee that we have a particular portfolio aimed at that particular inventory stream, but that's what we're in the business of. We're in the business of providing that opportunity to our investor clients. So the more inventory, the more off market, the more we have from around the industry, the better I think it is for everybody. And especially as we can start to prove out VCs that are targeted for specific types of assets in whatever state they're in. If we can start to prove that out, we can quickly partner with a lot of the industry entities that you mentioned to help them out, and whether that's disposition or whatever the case may be, in a way that really works best for everybody.